Hello, everyone, and thank you for joining us today for the Clean Technology ITC webinar 5.0. Just a few quick items before we get going today. During the webinar, all attendees will be muted for best audio quality. If you have any questions throughout the presentation, please use the Q&A button at the bottom of your screen to type in your questions, and those will be answered at the end of the presentation. This webinar will be recorded and shared with all of you within 1 week of today's session. And it is my pleasure to introduce our presenters, Fernando Melo, Jacqueline Gustafson, and Jeff McCauley. As CanREA's federal director, Fernando Melo leads CanREA's federal advocacy work, supporting members on federal government engagement priorities. Before joining CanREA, Fernando worked as a clean energy and technology public affairs consultant at PAA Advisory and Global Public Affairs, helping organizations find opportunities in Canada's transition to a net zero economy. And he also worked as a federal policy advisor at Clean Energy Canada. Fernando holds a BA in Politics and Political Economy from Trent University. Jacqueline Gustafson is the director of KPMG's tax incentives practice in the Western region. With over 12 years' experience, she specializes in propelling innovation and growth in the technology, transportation, manufacturing, and industrial sectors. Known as a SR&ED tax credit expert, Jacqueline is a frequent speaker at industry events and conferences, offering her specialized knowledge in strategic tax planning and funding. Jeff McCauley is the CEO of Charge Solar and a veteran in Canada's renewable energy landscape. With 2 decades of industry experience, he's focused on various clean energy technologies from hydrogen to wind to solar. In addition to leading Charge Solar, Jeff sits on the board of CanREA, aiming to achieve net zero greenhouse gas emissions by 2050. He holds an electrical engineering degree from the University of Victoria. And without further ado, I will pass it over to you, Jeff, to get us started.
Great. Thanks a lot, Tatum, and welcome to all of you who have joined. I just spent a couple of days on the road in the Okanagan with customers, and the ITC was one of the discussions frequently being discussed, and there's a lot of excitement but ongoing questions, and so we continue to want to invest in educating the industry. It is, as you'll learn throughout the presentation, there are still things that are being learned and discussed and shaped as we go here, but certainly customers have started to file their first ITC claims under the Clean Technology ITC. And we just wanted to get back together as a group and share our latest intel on how this is working in the market and what we've learned so far. For those of you that are not familiar with Charge Solar, we are serving over 1,500 active customers across the country. We are Canadian owned and operated and really focused on the Canadian market, primarily on the residential and commercial sectors. And historically, in the last few years, we've been more 80% residential and roughly 20% commercial. With this clean economy suite of ITCs, we expect to have a shift in that ratio and see further commercial growth. So as a reminder, we're selling directly to installers, integrators, EPC companies, et cetera, and we don't sell to end customers. And as I mentioned, these are the sectors we're serving. For those of you that have joined on previous webinars, we had the "We Are Here" arrow going from left to right on this slide. It's very exciting that we are now seeing additional clarity being added all the time. We are well within the eligibility period, and as I mentioned, certain customers have already started to file their claims under the Clean Technology ITC. But as a quick reminder, start of eligibility was on budget day of 23. And we reached royal assent of the legislation in June 2024 into law. Since then, and most importantly, and it was mentioned in the last webinar, but it was very early in those days, and I think it's still being developed. Most importantly, the CRA has really, in my opinion, done a good job to clarify in specifically these sections for industry how to use this Clean Technology ITC. And so, in my opinion, it's a great summary to say who can claim, so who are the eligible claimants, which equipment qualifies, how you go about claiming the credit, and what do you do after the claim. And it's written in my opinion, in a non-accountant language for the end customers to understand, those customers you'll be selling to as installers, and certainly to allow us to get up to speed as non-accountants. So I'm pretty impressed with the CRA's effort on this. So these QR codes that you see throughout the presentation, you can scan now as we present them, or we'll be providing a recording later and you can go back, but they're just links to the various CRA pages to help you if you go back and review this. As a reminder, I believe everyone's aware of this, but this clean technology investment tax credit is for Canadian corporations or REITs, and Jacqueline will clarify around the partnership angle, and specifically is for a 30% tax incentive that is reduced if you don't meet prevailing wage requirements, which we'll get to. In this presentation, I wanted to start with some practical advice for installers and how to utilize this ITC. And as with anything else that you're hearing from us on this ITC, Charge Solar is not an accounting firm, and this is not official accounting advice. It's simply advice that we have from the industry and what we've learned so far about the ITC. So I'm going to go through about 4 or 5 steps with just some really practical advice on how to utilize this. So in the early stages of qualifying an opportunity that you're selling a commercial solar or solar plus storage install to, the first step would be qualification. And very importantly, there is no pre-qualification. So for those of you that are used to a residential style program or even a utility scale, a commercial scale project being qualified through the utility in advance, for the Cleantech ITC, there is no pre-qualification form. There is no pre-energy audit for the commercial property, for example. And so that's really important. And that's good and bad. There's less paperwork, but it can lead to additional apprehension on the side of the installer or even the end customer. So it's something to be aware of. There's no pre-qualification. So as the installer, you'd want to confirm that the equipment type and boundaries, which Jacqueline will outline in a couple of slides here, that you're including only those pieces of the equipment that will become eligible equipment and therefore defined as the property that's being invested in and therefore claimed against. So that definition of the boundary really matters. Sometimes you're doing additional upgrades. Maybe the scope of work at that customer site is broader than what is eligible. So really making sure that those boundaries are understood at the time that you're qualifying the opportunity. Qualifying that it is a Canadian taxable corporation. Again, non-tax-paying entities will be captured under a separate ITC that Fernando will touch on briefly. But for clean technology, which we're focused on here, it's really for Canadian taxable corporations or REITs and partnerships in some cases, which Jacqueline will outline. And then this is a really important step to just make sure that the end customer knows that this is a corporate tax linked process for which they are ultimately responsible. So you can help them, you can aid them, you can point them to the CRA website, but ultimately the claim form is going to be through their corporate tax return T2 filing. They will be subject to audit. They will be filing it, and they will need to understand that the refund will be tied to that corporate tax return. And so it's, again, something you can aid in, but you're not going to be doing for them. And so early on, if you're working with a decision maker who is not the CFO of the organization or head financial person, ensuring that the decision maker is working with their external accountant early on, in that case in particular, is really important. So I just wanted to mention that. And then if you've now qualified that the equipment is eligible and that the customer, the entity that you're selling to is eligible, and you've engaged their finance person and you've moved on to quoting, then the next thing you need to start thinking about at the quoting stage is how to avoid the reduced tax credit. So if you don't meet prevailing wage requirements, your eligible claim will go from 30% the capital cost of the project down to 20%. And on commercial jobs, of course, that's a worthwhile 10%. It's going to be significant enough that even if you see the prevailing wage requirements as onerous and maybe not worthwhile for you, then your competitors are going to be offering 30% to that same customer. So you need to be aware of this. And in my opinion, most of the quotes that are going to go out are going to presume 30% and therefore compliance to the prevailing wage requirements. So there's a very nice section on the CRA website. This is the direct link to it, but this is an excerpt saying, avoid the reduced tax credit rate by meeting these requirements. So specifically, you must elect that you're going to meet the labor requirements, and the two main pieces are that you're going to pay people an appropriate amount, which again, Jacqueline will outline, and that you're going to meet the apprenticeship requirements. So they summarize it well here, but we're going to get into detail on that shortly. But my point at this stage is simply to say, when you're quoting, you need to go and look that information up, because of course it's going to affect your labor rates, which affects your total overall quote to the customer. So you'll need to do that early at the quoting stage. And I'll just describe what we think is a logical set of steps to take. So of course, prevailing wage requirements are tied to the quantity of hours spent on site doing installation of the eligible equipment. And so estimating your on-site labor hours by job code, and by job code, I simply mean that most of our installs are done by a combination of general labor and electricians. And you may have some other buckets, but just to keep it simple, those are typically the kinds of on-site laborers that will be involved in commercial solar. And so identifying the quantity of hours you expect by each one of those categories is step one. Step two is finding the most applicable collective agreement and save that so that you have it for your records, and identify for each one of these job codes what the total compensation rate is per hour. We're going to give you an example of how to do that and where to do that. But you would be doing this at the quoting stage to help you build that quote. And then in the event that your current compensation for your employees or your subcontractors or their subcontractors is not already at the total compensation level within the collective agreement, then you would plan to be topping up your employees for, again, only those hours spent on that project at the site. So, make a plan for that and how you're going to do that. And you also need to communicate to those employees why you're doing that, and or subcontractors. And so make a plan for how you're going to do that. And then also, as I mentioned, there's an apprenticeship requirement, and just make sure you have a plan for that as well. So for example, let's say you work with a specific journeyman electrician already on commercial jobs, and let's say that individual is going to sites typically on their own. Then part of the plan, part of your quoting buildup would need to contemplate that that person is now bringing an apprentice. And so again, we'll get into more detail on that in a bit, but just these are the simple steps you'd be taking at quoting time to ensure you're quoting a total price that is going to include all of the requirements to have the end customer achieve the 30%. Okay, the next step is now, let's say that you're fortunate enough that the customer has accepted your quote and you're going ahead with the execution. The first step is to actually go and look at, is the total compensation value that you acquired during quoting phase still relevant? Because this could be, commercial deals in this country can take sometimes upwards of 18 months to close, and certainly to get to execution. Maybe you're held up by the customer deciding, whether they wanted to proceed, or the utility interconnection process, or whatever it was. They can be dragged out over time. You want to make sure that you have the most relevant, latest, greatest total compensation information. So I would suggest you go back and refresh that data. The next is then, of course, just like you did at quoting phase, where you were tracking what you thought you would spend for time per job code. Now you have to actually track that and keep that. And that could form, if not in your attestation to the end customer that you've met the requirements, at the very least, if you were ever audited or asked by your customer to substantiate the amount of time spent at site, really, doing proper time tracking for each one of those job codes during execution will be important in our opinion. And similarly, if you are doing top ups, then ensuring that you keep record of that, and that you're not, for example, giving undocumented cash bonuses. I would highly recommend, making sure this is in your payroll systems, and that for that job, you create some kind of job folder and you keep record of having paid any top ups that were required, as well as a record of having informed employees why that top up was paid out. So if you kind of keep a project folder, and you have all this information of the time that was spent per job code, per project, any top ups and the payroll records tied to that, and any, I would suggest, written communication on informing employees of why that top up was required. Really just practical steps on what to keep inside of that job folder. And finally, how you achieve the apprenticeship requirement. There are some exceptions for this if you're in areas where you literally can't find an apprentice to be supporting any red seal trade work that occurs on the site. But it's just easier, honestly, to just meet the requirement. But Chakmin can speak to exceptions on that. So again, this is just some very practical advice from us on during project execution, what to keep in mind when you're doing an ITC project. Finally, oh yeah, this is important. So the language in the in the law now is the date of first available use. And what we take that to mean is the date of first economic benefit to the end customer. And so that, as you guys all know, can be different than initial commissioning. So if you commission it and you plug it in and it's all working, but you don't have permission to operate, and therefore it's not an economically viable asset for the end customer, you should be careful about the exact dates that are recorded for that. In our view, commercial operation means you have permission to operate from all required authorities, and that the end customer is generating revenue from that asset. And on that date, I would be documenting that that is your commercial operation date, and then that really drives which fiscal year your end customer is going to make this claim in. And so that's really important, particularly if you're getting close to when a fiscal year end boundary is, to record the date and how you define the commercial operation date, or again, using their language, the date of first available use. Okay, so now presume that you've executed on the project, you've commissioned it, everything's going well. How does the end customer claim this credit? So again, the CRA website, I've given another link. This is just another subsection of the same general website. There's good and bad news here. The good news is there is a form that is a T2 Schedule 31, which is a new form with which you claim the clean technology ITC. Again, it is attached to your corporate tax return under a T2. And that form it exists, it's out there. You should, when you're engaging with end customers, ensure the head of finance at your end customer site is aware of this form. And it's very nice that it's linked here. The bad news is that the form of attestation from the installer to the end customer is forthcoming. And at the moment, people are creating their own versions of this, their own letters. Jacqueline can probably expand on this, but this is because people are starting to make claims. This is being done somewhat ad hoc, and I believe anyway that the CRA is still working on a subsequent form that will be more of a standard form of attestation to say, here's specifically why the equipment is eligible. Here's specifically how we met the prevailing wage requirements and the apprenticeship requirement, and anything else that's in there. So as you're seeing here, the CRA is guiding you to say, until this form is available, you must, they're giving some guidelines here with what you would provide in your own form of response. Again, this piece is most likely going to be coming from the installer to the end customer, and the end customer is going to use that to substantiate their Schedule 31, which is attached to their T2. So that's the process. That's it. So again, there's just some practical steps from the original qualification of the opportunity all the way to the end customer making the claim. I'm going to pass it over to Fernando, who will, again, just put the clean technology ITC in context with other ITCs, and then over to Jacqueline, who will get into much more detail, specifically around prevailing wage, but the program in general. Okay, over to you, Fernando.
All right, thanks so much, Jeff. Really appreciate you walking through that. And again, appreciate your support and all of our advocacy to get the clean technology investment tax credit across the line, and our upcoming work, our ongoing work to get the clean electricity investment tax credits brought into legislation. Just quickly before we dive over, one of the things I will flag is that for all of you who are CanREA members, we will actually be sitting down with the team at the Canada Revenue Agency on November 18th. And so look for an email from the Canadian Renewable Energy Association on that, but we'll be sitting down for a webinar that I'll be moderating on a lot of those sticky questions and working with, and for those of you who are working with Jacqueline, it's going to be sort of supplemental to the great work that she already does. So we are putting that forward. So just on to the next slide, if you don't mind. So basically who we are. For those of you who are not aware of the Canadian Renewable Energy Association, we are the industry and trade association for the wind, solar, and energy storage industry here in Canada. We work with everyone from members who are installers all the way up to large independent power producers, folks like Jeff, who I have the great privilege of working with as a board member and a regular contributor to our federal network. And we do a lot of federal advocacy as well as advocacy in every province across the country. So we do quite a bit of work there and always encourage people to get involved, have that discussion. And a lot of the really important work that we've had around leasing and other areas, actually, I will give great kudos to Jeff and the team at Charge Solar for being sort of the inspiration and the folks providing a lot of that draft language for it. So thank you on that one, Jeff. And it's always phenomenal to work with you and Jacqueline on these sort of things. Next slide, if you don't mind. All right, so one thing that we do have coming up is the Clean Electricity Investment Tax Credit. A lot of you are saying, great, we've got the clean technology investment tax credit, but a lot of my sales pipeline isn't necessarily taxable paying. We know the much sector. So, you know, your municipalities, universities, schools, churches, housing, all these non-taxable are a fantastic sales pipeline for a lot of folks, especially people looking into investments. And another one is Indigenous companies and corporations who are active members and participants and partners on a lot of projects, and in fact are moving forward on a lot of these things, but they're currently left out because of their non-taxable status. So the federal government is proposing to bring in the clean electricity investment tax credit. It's worth between 5 and 10%, 5 and 15%, based on whether or not you bring in those labor standards. It says on here 10 to 15. They have clarified in the draft legislation, which was just put out, and we've provided comments on that it will be 5 to 15%. So for these pieces here, we really encourage you to take a hard look at qualifying for those labor requirements, as they will make a major difference here. We are looking at a lot of we're looking at an uphill battle on this, and I'm only saying that because currently we do not have the enabling legislation tabled. We are hoping to see that at the end of February, but Parliament remains in a deadlock over over some technical rules where the Conservatives and other opposition parties have been essentially holding up debate and pausing everything for the last 23 days. And we are hoping to have things loosened up soon so that we can get this legislation through, and it's very important. CanREA itself has been meeting with all parties on this, and Conservatives right through to the Bloc Québécois and New Democrats all understand the importance of these investment tax credits and are supportive of them for a variety of reasons. NDP like them because we have labor standards tied to them, and they're helping us with our decarbonization. Conservatives think we are just going deferred revenue and rewarding people for making the right investments. Whether or not that helps with the passage of legislation, we won't know, but we do know that the Conservatives themselves are interested in something down the line, should they form government or should government fall and they come in power around that. But we are holding our breath and working very closely to make sure that this legislation is introduced. In terms of durability, we are expecting things to change when it comes to the investment tax credit regime, simply because new governments always like to put their own spin on things, and whoever forms the next government will want to change things with either a red, blue, green, or orange spin on it. But from what our engagement is, we understand there is the idea we will tinker, but we will not destroy. And Jacqueline, you can weigh in on this one as well as someone who can also provide that. But one thing to note is we have a principle in Canada where you cannot go back and just arbitrarily remove a tax credit if it's already been claimed. You can't go back and just can't retroactively remove it. So anything that is claimed between now and whenever the next government comes in to make changes, the clean technology investment tax credit will stand until we see changing legislation passed. With that, I'll sort of leave it there. Looking forward to some questions, and I'm also really looking forward to Jacqueline's presentation, but that's just me.
Perfect. Thank you, Fernando.
Yeah, thank you, Fernando, and thanks, Jeff, for having me again. I'm happy to be here, and really great. It's been great working with you both and all of the other participants, really asking questions and so on. So we're all learning as we go. So yeah, happy to get on here again. So if you didn't know about us by now, KPMG is an accounting firm who is also doing more so than just tax. We do advisory and we work into other sort of areas of the business, from small to large to medium businesses. But we're here to talk about the credit. And so, like Fernando and Jeff alluded to earlier, we really are hoping that this credit will stay. I echo Fernando's comments on legislation once it has been passed. It is very troublesome, and new governments would not spend the time to go back and change legislation that has been set already. So at least for the CT, for the clean technology tax credit, we think that that will remain. There is an end to the credit. So the other thought to have is that there is an end to the credit. And so perhaps the new government will come in and make changes after that, or try to amend the credit before or after that date. But we don't think that anything will happen or will change. Aside from the forms being available and more clarity on it, we don't think that anything like that will change. So let's get right into it. So next slide, please. Just as a sort of overview and a reminder, this is what the credit is entitled to. This is the type of property that it's set in legislation as far as what is included in the credit. Let's just move to the next one. And I think that more so than, hey, we know, but we're solar installers, I really wanted to just keep this slide here just for you to be aware that other forms of property are also eligible for the credit. And the reason why I thought it would be important is because when you're out at a site and you are included solar in any of your clients or your customers, and they are in turn also including other forms of clean energy, then it may be good for you to know as an added value to say, hey, you're including also geothermal on this project or that project or whatever it may be. So just be aware that all of this could be potentially eligible. The next slide will show,
Jacqueline,
oh, go ahead.
Sorry for the quick interruption. We keep saying solar, and I keep saying solar and battery. Also, EV charging is listed here as well. And to your point, the broader suite, but certainly people on this call would be engaged in at least discussions on solar, battery, and EV charging.
Yeah, exactly. Thank you for that. Okay, so getting into, and I saw a question on the chat as well as to whether or not, where's the boundary, what's eligible, what's not. And so when we're talking about, and this is one of the things we've learned, is when we're talking about, so tell me the dollars and cents, like what is the actual property? Where are the items? How do we know whether or not everything is eligible or not? So this is an example of a solar array going onto a building, and NRCan, this is the old edition. So one of the new things that we've also heard is that a new edition will be coming up. We think it'd probably be April on when we'll have a new addition to this one, but this is the current one that we're all looking at for now. So in this case, there is a solar array that is on a building, and there is what is called the eligible system boundary. And so at the very sort of bottom of it, we're really seeing, the transmission equipment, power systems, inverters, or so on. But then the question comes on to, okay, well, if I have to do any engineering, any feasibility studies, any costs related to the acquisition and installation of the property, would that be eligible? The guide says it is. However, those costs could also be in a clean energy project. Those costs might also be covered under other funding programs or other grants. And so it is important to make sure that if they are related to the solar array being installed in the property, that those costs are only related to the installation and commissioning of that property. So hopefully that clarified that question, but if not, happy to go into it. So yes, the design, engineering, and commissioning of the property to make the property available for use could be eligible as long as they're not covered under other funding programs. Okay. So let's get into the labor components. Or sorry, no, that's an example. Sorry about that. Yeah, so move on to the next one. Okay, so this is an example where a client, Canadian taxable corporation, so let's just clarify that. So a Canadian taxable corporation is a taxable entity that could also form part of a partnership. And so that's where sort of the confusion comes into, well, are partnerships eligible or not? We're really looking at the taxable corporations that form part of that partnership. And so in terms of, we've been dealing with multi-million-dollar projects where you have a partnership because there's various players and stakeholders around that project. And so yes, the credit would be eligible as long as those members of the partnership are taxable corporations. In this example, though, it's a small and medium-sized Canadian taxable corporation. The average tax rate in Canada And just for the sake of keeping it all clean, the taxation year end is end of this year. They purchased $1 million worth of solar array or photovoltaic electrical generation equipment. And these costs are all eligible and to be claimed. Now, one of the clarities that I should make here is the legislation very clearly says that property has to be incurred and available for use after that date. That means that if the property is available for use after March 28th, 2023, in our example, that is the case. However, if there was a deposit made against that property ahead of March 28th, 2023, those costs would be eligible as long as the property was available for use after the March 28th, 2023 date. So very clear, we get that question a lot. So just a note there on that. Going back to our example, so again, the eligible expenditures were incurred after January 1st, so that works great. And then the eligible property is available for use after that date. So related to the 2024 tax return, it's important, and this may be a bit too much into the tax piece, but it's important to note that these expenditures will follow, or the refund follows the capital expenditure. And so the capital expenditures that are eligible for this obviously have or classify under a CCA class 43.1 and 43.2. And so then you are able to deduct or apply a deduction for that eligible property. In this case, in this year, in 2024, it was 75% enhanced allowance. And so then therefore the calculation to 525,000. Then we have the prevailing wage and the attestation and the election. So as Jeff mentioned, there's no specific form for that. We were expecting that on the Schedule 31, they would show the election at the attestation and then furthermore, but I think they're just trying to get some forms out. So until that is the case, there isn't any available. However, we do have to make sure that we have some working papers that speak to the fact that we are electing and attesting the prevailing wage and the apprenticeship requirement and how these are met. So in this case, we're saying yes for the first line there, second to last there, 30%. So then we would be including that 30% of the total value of the eligible expenditures, which in our case is $1 million. And then if we do not meet the labor requirements, then we go down to 20%, which is $200,000 on that piece. I have mentioned before, and I have had a few questions on this, and we have had a few questions on it as well as to, so the refund is earned and how is that applied in following years, and what impact does it have? And so for your taxpayers or for your customers that are going ahead and applying for the credit, very, very strongly suggest meet with our accounting people so that they are able to follow on their schedules. These are very simple examples that we're shown here. They do really need advice of a taxable practitioner or a tax practitioner to make sure that all of these are recognized properly in the current and in future years. Again, just sort of very, very lightly here to cover it, but it is included in income, but it does follow the deductions and on the capital expenditures. And so it does decrease future CCA deductions, but the mechanics are that there is an income and then a deduction for that year and for future years. Jeff, did you have anything else to add to that example?
No, I think the next slide is kind of the same thing in the table. And I think it's very important. I think we should hit one more time that very last point that you made because it's been contentious. And so to sort of re-baseline the undepreciated capital cost after that second year income is really important. So let's look at the table and then we can hit that last point again.
Yeah, so this is an example that shows where there is no ITC or no benefit of the ITC, and then where there is a 30% where the labor requirements were all met. And so on the top there, you will see that you have, again, the $1 million expense, and then there's no deduction or no inclusion of the 30% ITC. Your net cost, or the net cost to a taxpayer, small, medium-sized business that has an average of 27% at 2024, maybe that's what we should add there, or yeah, we did net cost 2024 is just under 800,000. Pardon me. And then the second one, the second part there is just really going through it. The net cost is about what, 100 and something less, at a total of $639,000. So just like you mentioned, Jeff, it really illustrates what the difference might be having the ITC and not having it.
And maybe using that example, if you could, I know we don't have it on this slide numerically, but you're just saying that in the second year, let's assume this is a 2024 tax return and that the customer's fiscal year is the calendar year. And then in 2025, they have to claim the grant or the credit that was received as income, as stated here. And you're saying that also in the year two tax return, they would amend the undepreciated capital cost of that asset.
In the future one, not in the current one,
Right.
but in the 2025, yeah.
Right. And maybe you can just say a few more words on how that would be done.
Yeah, so that is an include. I can give you the specifics on it. I know I have them written. I don't know them by heart, but I could do that, or I can add it to the questions in a bit. So it's a Schedule 1. So it's an inclusion in Schedule 1 and then a deduction as part of 13.7.1. But I can put that in as a bit of a follow-up.
Okay, great. Good. Okay, over to labor requirements, and I'll dive right into the first slide.
Yeah. So for those of you who have not seen the slides, they're very wordy. But we really thought that it would be good for you to at least have something that you could refer back to after the webinar, and that you're also able to read through it. Not intending for you to read it all. Really, what we want to be looking at here is that the prevailing wage that you're paying, like Jeff mentioned before, really has to be, it could be topped up per se. It does have to occur. So this is one of the questions that we've had. It does have to occur for those covered workers at the designated work site. And so where this comes into play is, for example, when clients or entities purchase property, but the installers are not the ones that, or the sellers, the vendors are not the ones that are installing it. Is now the client or the customer or the company that's installing it. And so these are really only related where you're selling the solar equipment and you're going to install it. So now you have covered workers that are going to be performing these activities at the designated work site. And so then that's just something to consider there. And then I did see a question on the chat about, well, what if there's no collective agreement? And so then it really is, if there's no eligible collective agreement, compensated in an amount at least equal to the amount of wages and benefits required to be provided for employees under an eligible collective agreement that most closely align. And so then they have something else, cover work experience level, task, location, and so on. And it is calculated on an hourly basis. So hopefully that does clarify that question that was asked on the chat. And I think, Jeff, we talked about something. It may not be on the slide, though.
Which item?
The collective agreement, but I think.
Oh.
Where did you have that?
It's next. Yeah, if you want to cover that here. Yep.
Yeah, exactly. So this is just a prevailing wage example. Jeff put this slide together. I think it's great. It just gives you a resource, and there's no barcode on this one, Jeff, but feel free to Google that in prevailing wage, Canada's building trade unions, and it'll give you an idea of where you can research or have a look at. And there's a phone number there, as well as some other information available to you. Did you want to say something on that, Jeff?
Yeah, I'll just add quickly, you can register as under, I think, resources, but you can register and then you get into their ITC portal, which they're referencing here, and then that allows you to download the collective agreements themselves, which we're going to show an example of on the next slide. And I think one additional point there is that as the CRA website continues to add detail, and now the CBTU website adds detail, it helps you as installers to substantiate the program to your end customers. It's becoming much more real as we see references to it in all of these other locations. And I know that will be an important part of the sale process when you're describing that they will be eligible for this credit. Well, they're going to go do research, right? And so there's just more and more resources now to, like I say, substantiate the program. And then we wanted to actually show an example. So maybe Jacqueline can speak to this, and I can add if needed.
Yeah, so just a quick example here of two individuals, journey electrician, and then the third term apprentice. So the reason we chose those two, or Jeff chose those two, is because one of them speaks to the labor piece and the other one speaks to the apprenticeship item. And so as you can see here, really the total monetary package for that individual on the right-hand side column is coming up to, for example, the journey electrician is $64.99, and then the third term apprentice come down to $41.22. So these are some of the things that documents that you do want to have in hand. So if, for example, if this was your example, or this is something that you could use for your own workers, then you should have this as a document readily available. We expect that most of the claims will be audited. And so that means that your customers are then going to have to respond to CRA according to how that labor requirements were completed or were met. And so having such documentation as this one is very valuable on that point, so that there's no that back and forth. Oh, I think I did this. So I think I did that. It's just very clear saying this is how we came up with it. And this is what is all encompassing in the complete package on each of the workers.
We're going to cover it in the frequently asked questions slide at the end, but I'll just say briefly here, there is no solar installer job code yet. Hopefully over time, we'll see that being included in these collective agreements under the CBTU. But again, this is not formal tax advice, but we have heard people that are claiming this using general labor and or roofer job codes for the general assembly work of commercial flat roof solar, for example, in addition to the electrical work being used. So again, that's not formal advice, but it's what we've seen other people doing.
Okay, more so on documentation and sort of prevailing wage requirements. So there needs to be a communication between yourselves and your workers about, why you're doing this. How is it sort of the work undertaken? Now, we've had clients who come to us and say, well, look, this is all I do. Like, why would I need to communicate this to them? And, I have 50 people that are working under me that are workers. And so we just suggest that, it could be if everybody else has an email address, which sometimes they don't when you're talking about trades and so on, but anything that communicates the fact that what you're working on could be eligible for your customers then accessing the credit. That really is all CRA is looking for. They just want to avoid anything that could be sort of underhanded between management and the labor that is actually the workers that are working on there. And then some considerations, I don't think we need to go into every single one of them, but it's just some of the considerations that you need to keep in mind. The one that I wanted to touch base on was the subcontractors. So in some cases, US installers might have a subcontractor that would then come on board, and it may be for a number of reasons, but you may have him or her come on board to provide a certain labor requirement for that project that you're working on. It is also important that they realize, or that they are aware, that your customers may eventually be claiming this 30% with the labor. And so therefore that communication between not only your laborers, but your subcontractors is also important. Okay. Apprenticeship requirements. This one we've had tremendous amount of questions on it, more so because we do have entities that don't have more than 1 or 2 apprentices. And so now they're saying, geez, do I have to have 10? Like, how is this going to work? And so what we're just saying is, or what CRA has said, and I don't know, Fernando, if this is something that you've discussed with them as well, but you just have to abide by saying, look, if it is 10% of the total project, this is how I have calculated it. Now, if you have an apprentice on not an apprentice on year one, but then halfway through the year you have one, so therefore that apprentice is not 100% on the job for that year, that's okay too, as long as, again, we can document the fact of why you don't have the apprentices readily unavailable for that year. So it is sort of a bit of a, well, I don't have that many apprentices. I'm making every effort to hire these apprentices. This is my documentation related to how I'm doing that. I'm communicating with schools, I'm posting my jobs and so on. So I don't know that it'll go down to that level unless there's very obvious flags within the claim, but it is something to be aware of.
I'll just echo those comments and say that we have had some conversations with unions already around apprenticeship availability across Canada and different places. And the advice we've had informally is exactly as Jacqueline provided by both unions and the CRA in my conversations with both.
Great. Okay, so what happens if you don't meet? Oh, go ahead, Jeff.
No, that's fine. Yep.
So what happens if you don't meet them? Or what happens if you say you did meet them, but then when an audit comes into play or comes up, then you didn't meet them? And so there is definitely consequences for the taxpayer. So the next slide will just have some sort of is the next end of the apprenticeship. Yeah, just the top part, which we talked about, but the consequence is the second part of the slide here. There is a consequence for the taxpayer. And so then it is important that you have that communication with your customers who are claiming the credit, and you're both on the same page as to the labor requirements that are needed from you and any labor requirements that are needed from them. So a very clear distinction as to you're providing the installation and it comes with the labor, and therefore we abide, or maybe we don't meet the labor requirements, but it does have to be a transparent conversation, because the consequences obviously don't come back to you, but they do come back to the taxpayer, and you really wouldn't want to have any of those conversations when that occurs. But this is just some specifics from CRA as to how this will come about. So there is some prevailing wage consequences, again, treated separately. So you meet the prevailing wage and you meet the apprenticeship credit. You could meet one or the other. And if you meet one or the other, then if you don't meet the other one, then these are the consequences for each. And so the prevailing wage consequence is a number of value for each day in the installation year for each covered or each worker that was not paid the prevailing wage. So in 2023, they're saying it's going to be $20. So if they didn't meet it now, for 2023, we're only talking about a month, right? So we're only talking about November 28th, 2023 until December 31st, for example. And so for that fiscal year, calendar year, we're talking about $20 and then more thereafter. There's some penalty there that you could really use for your own examples related to the amounts that might or might not be paid. Now, again, if you meet the requirements and you're substantially satisfied and your clients or your customers are also satisfied, then there may not be need to do this, but just really aware that there will be a consequence if an audit takes place and the labor requirements were not met. Okay. So this is before that last form, the T31, came into play. Your customers will need to have all of this information for them to make a credit or a claim for the credit. So when Jeff was mentioning, we have this, but we don't have the labor, the attestation, or how the calculations were performed or whatnot. We as KPMG have now tools and templates that we provide our clients. They say, this is what is going to be needed. This is what we're submitting to the CRA. Now, this may look like all not like numbers and whatnot, but if you remember the SHRED program or anybody that's involved with the SHRED program, that has also always been the requirement of a project description, whether that used to be a novel in the 80s or whether it's now a 1,400 word limit, there has always been that requirement for any of these types of credits. So what we have done as KPMG, we have actually developed a bit of a form that includes a bit of the description. Now, it's not an onerous description. It just really identifies the property as being eligible and the reason behind it with the wording that is speaking to what CRA would be needing. And so then, whether that just means, yes, purchase and installation of our solar array that is X large with all of the parameters needed, that is perhaps fueled by, if there's other equipment that's required on it. So it is important. We think it's important when the audit comes into play. Again, we're thinking they're all going to be audited, to at least have some reference to some color, if you will, to CRA saying, this is who the company is, this is what the project is about, this is why the credit applies to them, and then have all of these calculations set for and available for CRA. So hopefully the form will come out and then we won't have to make all our separate tools and that. And I can tell you all our accounting firms or other tax practitioners are definitely working through this as well. Okay, you want to speak to this one?
Yeah, just to again zoom out and provide the clean technology ITC, which is listed here in the middle as part of a broader set of clean economy investment tax credits. So unfortunately, that acronym is the same as the clean electricity ITC, but the broader suite you'll regularly and increasingly hear referred to as clean economy investment tax credits. So as you can see, there's a variety of others. The primary ones, as we've mentioned, will be the clean technology, which is already out, and that's why it's on this page, and the upcoming clean electricity ITC for those of you on this call. And thank you very much, Jacqueline, for that. And I would like to move to, I'll just do a very brief overview of Charge's ability to support these commercial projects. Then we're going to jump to an FAQ section because we do see some recurring themes in the questions being asked. So we want to proactively answer a few of those, and they are very well aligned with the remaining questions I've marked as answer live in the Q&A window here. So just briefly, I wanted to share, we continue to be well stocked on commercial scale solar modules from Longi, JA, and more recently Thornova. So please reach out if you have questions on those. But we continue to believe these are the three brands that we'll be backing for the tail end of 24 and going into 2025. We have an increasing quantity of commercial inverters available, including, and I just recently added this, commercial scale 3-phase microinverters for 208 volts. I'm pleasantly surprised to see some of those coming in higher numbers than we were expecting, but some of the incumbents you'll recognize on here as well. So SMA and Fronius and SolarEdge, who have been around with 480 volt and some 208 volt options for a while. And then Solus, of course, has the 600 volt option, as well as a suite of 480 volt products. And 208. And then on the racking, of course, we have, we're primarily backing the Fast Rack brand, but if you have a specific application that we don't have a solution for, of course, we'll do a referral, but we have Ultra for slope roof, Avenue for flat roof, GMX and Titan Light for ground mount solutions of varying types. And finally, and I'm really proud that this list continues to expand, we can provide professional engineering support to do sealed drawings for you and for your end customer sites in an increasing quantity of provinces and territories. And now there's just a few left to cover the entire country. So congrats to our team that continues to add that and grow the team across the board. If you're doing your own in-house engineering or you have your own firm, of course, that's great. If we can help you on any of this stuff, even better. So yeah, happy to share that. Thanks everyone for your attention. And like I said, I'm just going to start the Q&A with the frequently asked questions that we know that we were going to get, and I wanted to cover a few of them. I wanted to start with one that I did not have a good understanding of, and I thank one of our installers for helping me to dig into this a bit more. And so this first one's around recapture risk. And so Jacqueline, if you don't mind, maybe just summarizing the rules around this and considerations, and I'll if needed, I can weigh in on that too.
Yeah, for sure. So the equipment, I'm just going to try to go in here to find my notes on it. But yeah, so the capital property has to be new to the taxpayer, and it cannot be converted to non-clean energy. And so then there would potentially be a recapture if the property is disposed of, so sold to somebody else, or disposed or ceases to be non-clean energy use. If you sell it to somebody else, that somebody else is not able to claim the credit because now that property has been used.
Yeah, and so this is an important clarification because I was not under that impression, and I think it may have been that I was misinterpreting the disposed of terminology, but that's a really important consideration because it will be a barrier to entry on commercial jobs, unlike I think larger front of meter jobs, and so or let's say more so. And so your end customer is going to need to have that longevity and realize that they're going to have to pay back some of that credit should they sell it, even if the buying entity is another eligible company or corporation. And even if it's not converted to a non-clean use, they're still going to be at risk of recapture for the full 10 years. And I think that, it's partial. It is kind of a pro rata formula that you can look up, but important clarification.
Mm-hmm.
Okay, the next is, again, this one was, I guess it's been around since June or so, but originally the language simply said a publicly available collective agreement, that is appropriate in that area. And in my opinion, Jacqueline, and you can clarify, they later added a much stronger link to the CBTU. And
Yes.
I think the upside of that is that there is a referenceable standard, that you can go and look up, and that's great. And we showed the example of that. The downside of that is that it's much more stringent, in my opinion, than a publicly available collective agreement of any sort. And so I have been learning as we go, like all of us, and want to clarify that this is needs to be linked to CBTU.
Yep.
Stackability. This is probably the majority of the questions in the chat, and no surprise because there continues to be both other ITCs out there, such as the Atlantic Canada 10% ITC, and or utility incentives such as Manitoba's program or BC Hydro's new commercial solar and storage incentives. These are often ratepayer funded and not taxpayer funded incentives, and they aren't associated with the corporation's tax return. And so, Jacqueline, if you could just weigh in on stackability and generally how it would affect our examples.
Yeah, so yes, but so BC Hydro, for example, I know that you're across Canada, but just as an example, I know Manitoba has them as well, and on the East Coast. So any of those benefits are more so in the form of rebates, where you receive a rebate after you have purchased and you have proved that you have purchased that. And so in year one, again, if we go back to our example of the fiscal calendar 2024 year, if you're thinking about getting a rebate that might have come into play in 2024 for against that property value. So an example, $1 million, and a portion of that is part of any of the utility rebates, then that should grind, or that would grind the eligible property value for that fiscal year. That's a very simple example. There's a lot of other ones. So the Atlantic tax credit, for example, you are also able to claim it as part of the property required. But again, there needs to be calculations on it. So when we talk about the stackable limit, you are able to claim other ones. It just needs to be calculated for that fiscal year and the timing as to when those become available. So if you file, for example, a tax credit related to the $1 million in year one, but then in year two, now you're getting that BC Hydro or any other ones because it didn't come into play before December 31st, then there's a timing issue that you or your tax practitioners need to consider as to how you're claiming that credit. So yes, but it is a case by case, and it could be a bit of a timing issue as to when you would receive the benefits.
And so just to elaborate a bit, because again, this is a very common question and important, of course, at the sales phase. So if we assume this example, let's use BC Hydro's credit and assume that this project was getting just to make up a number, you know, a $50,000 credit. And if it were in the fiscal year of, in this case, 2024 or year one, as we're calling it here in this example, are you saying that the eligible expenses would be reduced by that rebate amount? And then you would calculate the ITC at 30% of the amount remaining net of that first incentive?
For that property. So the key
Right.
here is that for that, so that $1 million spans the entire project, right? So you've got the equipment and you've got the panels and you got, so the rebate may be specific to one of those properties. So it has to be related to that same property.
Makes complete
Does that
sense.
make sense?
Yep.
Yeah, okay.
Yeah. Okay, perfect. That's very helpful. And of course, it has the general caveat of confirm the specifics with your accountant, but or with the end customer's accountant. But I think that's really important because we are seeing an increase in quantity of other incentives, which is great. Okay, we always get this one. Typically, we didn't get it this time, but if we can quickly just touch on a corporation that is being that is physically located at a home address in a residential building, is that eligible for a clean tech ITC?
Yeah, so that we also get it a lot. So the taxpayer, the corporation that is paying, making the claim has to be using the property for the corporation's use. And that could be taken a number of ways. Is it a percentage that you're claiming based on your residence? Is it, you know, is it mostly used for it? Is it substantially all used as a corporation? So again, I think the bones of it is that the corporation has to make the credit for the solar array being made for its own use as a corporation. We're getting sort of more detailed into that because, you know, if you have a larger residence and then you only have a portion of that residence being as a taxpayer or a corporation. And so how do you determine that? So we are definitely getting into more of that. But again, the bonus is the corporation has to claim it for the use of the corporation.
Great. Yep, very useful. Okay. Repowering and upgrades. This came up on the last call. Again, I was a bit surprised on this one, but specifically in Ontario, but in general, we're going to see commercial scale repowering occur. And that could mean, Jacqueline, just to be clear about it, it could mean expanding or upgrading the technology used for the solar panels themselves. So, you know, panel swap, just to be simple about it, or a upgraded solar modules as well as an upgraded inverter, either increased in capacity or not. And so if we are doing repowering in that way, is the new equipment that is put in, even if it's part of a broader pre-existing system, eligible for the ITC claim?
As long as that property is classified under 43(1) and 2 and it's new property and it's not refurbished, correct?
Right.
Like
so
yeah.
Yeah, installing someone else's used panels to do repowering would not count, but a brand new set of panels would count under the ITC, only for the new eligible equipment.
Correct, because we're not looking then at the whole system, we're just looking at the components of the system. So as long as those components have been classified as 43(1) and 2, so that would be the advice going back to your customers if you're doing in this scenario, where you then say to them, hey, you know, this should qualify. And again, caveat here, I haven't seen any specific item of that equipment, but if it did qualify, then it would have to be classified as 43(1) or 2 in their schedules.
Right, perfect. Okay, well, specifically if you're in Ontario, I think that's a very compelling opportunity for Fit 1 contracts that are now definitively repower eligible, let's put it that way. Okay, so union dues netting off prevailing wage rate. I don't mind handling this one, Jacqueline. It basically, this has come up a few times. I think installers rightfully are saying, okay, we're accounting for all of the benefits of union-based employees under the CBTU, but there's also costs to those employees to be part of the union and to be eligible for those benefits. And so given that the non-union based covered workers will not have all of those benefits, and we're going to top up on the benefit side, do we also need to account for the union dues as a cost? And so we don't have clarity on this yet. It's come up a few times and it's actively being investigated and discussed. And as we learn more, we'll share that. This is asked in the questions, and I might just expand on it. You covered this during the eligible equipment slide, Jacqueline.
Yeah.
But if we can expand on the question to include solar farm estimators, for example, so that is on-site work, but it's not necessary. I mean, you could cover it under preparation, which is one of the words used for the covered work, but that's one of the questions, and then one of the others is actually that's unrelated, the project fee. So yeah, let's just include in structural engineering, structural upgrades, as well as solar farm estimators, and we can just make sure we're clear on what is and isn't included.
Yeah. So there's structural upgrades. So two things. Structural engineering is one thing because it could be incurred as a needed expense for you to be able to then install the solar equipment. As long as, so again, going back to your customer, and they would have to do this, is as long as they capitalize those costs, again, this is capital equipment, so as long as they capitalize those costs against that project, then any of the sort of pre-feasibility, like I wrote down there, feasibility study expenses, process engineering, then those would be eligible to be included as part of the capital expenditure. Again, they would have to go and make sure that their tax practitioner is classifying that properly to be done. Now, the structural upgrades, they would need to be excluded, or they appear to be excluded specifically by the technical guide. So if we go back to the boundary, they're really saying, look, if you're doing structural upgrades to that building, that's not going to be included. But if you need to do any feasibility studies around how the structural the building needs to support the new extra weight and so on, then that would be eligible. Again, we've looked at it where there was some necessary structural pieces ahead of installation. We've kind of gone back and forth on that a bit. I don't think it's specifically clear. We have reached out to NRCan to make sure that they are very clear as to what's specifically required, but as it stands right now, the actual structural upgrade in that example, again, of the roof would not be eligible, but any of the feasibility studies, engineering, structural engineering that's required to see if the roof would sustain, then that would be eligible. As long as those are not covered through other programs. Again, I go back to that because there's a lot of qualifying here, but it's just as long as they're not covered under other programs.
Great. Okay, I'm going to keep us moving here. So the one of the questions, and I saw a couple of these come through, but the question I'll just read out, Jacqueline, is there a plan to get additional prevailing rate territories in Alberta? Right now, there is one prevailing rate territory in Alberta, and it is, it appears to be Fort McMurray rates, is what the person said here. Where in Ontario, there's 19 different rates. Fort McMurray rates are too high for Southern Alberta. So I'm not sure if you have a position on that or not.
I don't, unfortunately. Go ahead.
I don't have a formal position, but one of the things that we have been working with at CanREA is understanding the International Brotherhood of Electrical Workers position and working on that. Right now, they note there is only one agreement for Alberta, and they are working with the Canada, the CBTU, as well as the CRA, sort of understand and how it would apply for all of the province. But that is something they have said, we have one agreement for the province.
Okay.
But again, we are seeking clarification and working with them on it.
Great. Okay, perfect. This next two I'll combine, Jacqueline, are tied to eligible entities. So one of them is saying they have a client that has a property that is owned by a Bear Trust. And the other one is saying often farms are not owned by corporations, but by individuals. Are farm businesses eligible?
Yeah.
You can answer both of those.
And so proprietors are not eligible so far. There's nothing that I've heard, unless Fernando, you've heard anything coming back from that, but I haven't heard anything as to self-proprietors. So one of the other things our team is doing is looking at restructuring or structuring for future gain if the ITC, if claiming the ITC for such entities would be favorable. So we're doing a lot of work on that, on structuring. The Bear Trust, no, not eligible. Again, unless that trust has any taxable corporations, which is normally not the case. But again, we're doing some restructuring modeling to see if the benefit outweighs the cost of changing structures. Again, very high level stuff or very in-depth stuff that needs to happen. But sorry, I can't respond with more details on that for now.
Yeah, no, that's great. That's very helpful. I'm going to shift back to depreciation schedules and tax treatment. So we described that you can claim at the moment 75% of the undepreciated capital cost and in year one. And then the question is around what is the remaining depreciation schedule after that?
I think it's 50%. I don't have it on here. I know it's very available, so I could probably pull it up.
Okay.
But I think it is 50% for the next 2 years. Let me just see if I can quickly get it. If not, and if somebody gets it on there, then. But yeah, do you have something else while I?
Yes, yeah, I can do that. The other question was, can a developer's sale of utility scale PV project fee be claimed in the ITC by the new buyer? And so in summary, from my perspective, the CRA is not taking a position on fair value of these assets in terms of whether that fee is included or not. In my opinion, if the buyer is buying the asset and whatever they agree is fair market value and they purchase the asset, that is the amount that's used as the basis for the ITC claim. And so if that developer fee is included in the price of the asset, my belief, Jacqueline, is that that would be included.
Correct. Yep.
Great.
I haven't seen anything related to that or being flagged as on there that at all.
Great. And then I'll do the next one while you're looking up that other answer. I'll just read it aloud here. If we utilized a normally non-union subcontractor for the installation, seeing they are required to provide union rates through the BTUs and for only executing solar projects, can the BTU impose the collective bargaining agreement on them and make them a unionized company? No, I do not believe that is the case. It's my personal view on that. The next is, do you have an example of the communication shared with covered workers receiving a top-up of prevailing wage? Certainly I do not, and I'm not sure if, Jacqueline, if you've seen anything or would be in a position to share that.
Nope.
Okay, so the key, and probably the most important part of that question is, what are the key components of this communication? So that is outlined on the CRA webpage. So I know I keep referring back to that, but it's section 2 under the how to avoid the reduced tax credit for clean economy ITCs. And specifically under section 2, it says you must communicate that a designated work site is subject to prevailing wage requirements in relation to covered workers and how they can report to the CRA any failures to pay prevailing wages. So it outlines quite clearly what you must communicate, and then it outlines how you communicate it as well. And so I encourage you to go check out that section of the site.
Yeah, and our slides have that too. So you can also refer to our slides on that. It's 55% in 2026 and 2027.
Okay, so more of a declining balance, not straight line following that first year.
Yeah.
Okay, great. That one's done. And then let's see. Industrial rate, commercial. Yeah. Okay. Perfect. We had an additional clarification, which I'm just going to post here. But the additional clarification is that under electrical, there's a commercial wage and an industrial rate, and I think that's a great clarification because a lot of the work we'd be doing in this example would be commercial. I'm sure some will be industrial, but most will be commercial. Commercial journeyman full package as of November 3rd, 2024 is $58.75 an hour. Industrial is $70.05 an hour. So that's important difference. That's a big difference. And I think relevant to make sure you're looking up the right region and then the right job code. And in those collective agreements, there are different sections for commercial versus industrial. So just be aware of that. Okay, I think that's the end of the written questions. I'll just do one final call in the Q&A window if you want to type in any additional questions, and otherwise we'll wrap up. Okay, well, thanks again to our panelists and to Tatum for organizing us as usual. Really appreciate it. We will continue to share what we learned on this program, and good luck getting out there and using the Clean Technology ITC.